Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Christian Nagler, partner at Kirkland and Ellis, to discuss what SPACs are, how they are different than IPOs, and with an outlook on capital raising. Christian, it's great to have you with us. Welcome to Trade Talks.
Jill, thanks so much for having me. I'm very excited.
All right, Christian, we're hearing a lot more about SPACs in the financial media. Give us a brief background on them.
Sure. So they've been around for a while. Effectively, a SPAC is a special purpose acquisition company that will go out, do an offering on one of the exchanges, Nasdaq or New York Stock Exchange, and it will offer securities to investors that are units typically, although we've seen a trend in life sciences to just do common stock, but units that have in it a share of common stock and a warrant or a fraction thereof. And the money goes into a trust and typically can only be used to buy a company. And the investors have the right, once the company is presented to them, to seek to have their shares redeemed at the amount of money they paid for the unit plus any interest that's accrued on the account.
Why are they growing in popularity as a means to take companies public?
It's been growing a lot in popularity before we were hit by COVID, because people saw successful transactions on the back end, like companies selling to SPACs, trading well, very well-known private equity sponsors selling to SPACs, so they started growing in momentum. We saw a pause with COVID because of the market gyrations, but a month, sort of beginning in April, we started seeing a lot of what we call de-SPACing transactions, where companies look at SPACs and say, this may be a better way for me to go public, because there are some features here that make the marketing easier and give me a little bit more certainty that the transaction will close at the valuation I'd like to have.
And that was my next question. How are they different from IPOs? And I'm sure valuation is one of those metrics.
So yeah, so typically they're offered as an IPO at $10 a share, but for the target company, the actual operating company you seek to acquire, what's different for the operating company is in the typical IPO route, you start the process, you file with the SEC, and only towards the end do you put in what we call the price range, where you go and market the deal. So a lot of work is done before you actually go out with the price range of what you want to market at. In the de-SPACing transaction, the target company, the owners say, hey, this is the price we want to have. This is the price we'll agree to with the SPAC of what our valuation needs to be. And then the SPAC takes that valuation, they get an LOI, and the SPAC typically markets that valuation on a confidential basis to PIPE investors, to some of their own investors, and also to investors who typically invest in the industry that the target is in. And when there's momentum and investors start saying, I like this, and the PIPE investors who are providing additional funding saying, I'll buy in at this valuation, I really like this, then there's momentum for the transaction, and the target company has much more certainty that they'll get the valuation they need because there's committed financing. The next thing we see is, in order to do the PIPE marketing and for the board of the SPAC to really evaluate and come to determination on price, we have used projections, and the transactions are often marketed off of projections which are made public.
Christian, where does Kirkland fit into the SPAC ecosystem, and what are some deals that you've worked on?
So we do a lot of IPO transactions representing on the SPACs, representing issuers, often private equity sponsors, and also underwriters underwriting the transactions. And then we have a thriving M&A practice where we represent SPACs acquiring target companies. And also, because of we have a very strong private equity franchise, representing a lot of private equity sponsors selling their target, their portfolio companies to SPACs. And we call that company you're selling as the target. And so we've done a number of transactions this year. On the SPAC side, we represented Collier Creek in its purchase of Utz Foods, exciting transaction. We did a lot of life sciences, 2 transactions for the Aria SPACs. So we've done a lot in life sciences, a lot in the SPAC side, also Leo Holdings. On the side of representing the company being acquired, we are on the multi-plan transaction, which is very exciting. They're all very exciting. We're on the Rush Street transaction. So we really play on representing SPACs and also representing companies being acquired by SPACs.
So Christian, to wrap up here, you've mentioned life sciences. Are there other spaces, other industries that Kirkland favors?
Not necessarily that we favor, but the trends we're seeing, we do a lot of consumer transactions. We do basically all industries. I would say at the moment, what's developing very quickly is life sciences. And now we're seeing life sciences IPOs. We've worked on a few where the SPAC is no longer offering any warrants. It's simply offering common stock. And what's better for the SPAC there is that means there's less dilution being brought by the SPAC when it seeks to acquire a company, to the target company. And it's a huge development in life sciences where we're seeing companies, we think, instead of opting to go the traditional IPO route, are really looking to the SPAC as a late stage financing and IPO opportunity.
Actually, one more question for you. What's the difference between the warrants and the SPACs for the benefit, and the stock for the benefit of the audience?
Sure. So what's attractive to the IPO investor is often in SPACs, typically in SPACs, the IPO investor gets a unit and it has the stock that could be redeemed down the road, but it also has a warrant in it. And typically after 52 days after the IPO, the investor can split their warrant from the stock. So the unit breaks. And if the investor decides, I don't want the warrants anymore, they can get some value for the warrants, because warrants typically always have an intrinsic value, and still hold on to the stock, or vice versa. So if you never like the deal and you vote to get your money back, which is typically sitting in treasuries, you get your money back plus interest, and you keep your warrant.
Christian, great insight. Thanks so much for joining us on Trade Talks.
Okay, thanks so much for having me.
You got it. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.